Okay, I can see that we've had quite a few people join us this afternoon. So good afternoon, everyone. It's wonderful to see so many of you taking time out of your day to join us. I'd like to welcome you all to CiC's session called Financial Wellbeing Safety Net, a Beginner's Guide to Protection Insurance. My name is Ivy Murdoch and I am the Financial Wellbeing Stream co-lead here at CiC, and we're thrilled to conclude our 2025 Financial Wellbeing webinar series with this particular webinar. We will be releasing the programme for 2026 soon, so do keep your eyes peeled for that. Our host for the session today is Darren Ford, and the aim of the session is to be as interactive as possible, and we do invite you to ask questions in the chat function. Let us know where you're joining us from, comment, post any questions as we go through. I have with me my colleague Jake today, and Jake and I will be collating the questions, and don't worry, we have set aside time towards the end of the session for Darren to respond to any questions, comments, thoughts. And just a very brief note though around today's session is that, as with most financial wellbeing products and kind of information, protection insurance can be incredibly complex as a topic, and individual requirements depend very much on kind of your circumstances and what's important to you, as well as what products may be available, which could vary around the world. So we will focus on UK protection insurance products, and we will also briefly touch on protection for businesses as well, just because we're conscious that some of the people who join us on these webinars may have a need for that. And again, just a bit of a disclaimer, Darren will be providing information and guidance during this session, so rules of thumb around protection insurance, what to be aware of. We won't be able to provide specific financial advice, as this requires a deep understanding of each individual person's financial circumstances and situation. But we will try and share links to support you with finding financial advice, and Darren's also sharing his details on the screen now, and we'll share these again at the end of the webinar. So with that being said though, I am very confident that there will be things to consider and best practice that will be universally relevant to all. And just to add from a housekeeping perspective, the session is being recorded. So if you would like to watch it back yourself, or if you have any colleagues that have perhaps not been able to join us today that you think might be interested in watching the webinar back, please do let them know. So without further ado, over to you, Darren.
Hello, yes, afternoon. So thank you for the introduction. Yeah, my name's Darren Ford. I am a qualified independent financial advisor and mortgage and protection broker. I know I'm probably not the fun one at parties. I am a bit of a geek. My job is to talk about pensions, investments and savings and mortgages. So you may have been on the previous webinars where I discussed mortgages and pensions. This one, I want to talk about personal and business protection. And I'm going to share some stories that may resonate with some, if not all of you, because they're based on real situations that happen to real people every day. So my goal is to help you think about financial protection in a practical way. So I want to start with Emma's story. Now, Emma came to me a year and a half ago. She'd become a client, and Emma, like I think a lot of people, kind of felt that insurance wasn't really for her. She's 38 years old. She's a marketing manager. She's got 2 children, aged 7 and 10. And again, like a lot of people, she has a mortgage. But during our discussions with insurance, again, she felt like it wasn't really for her. It's not something she needed. She was busy. So again, it's just not something that she was concerned about. Until her friend and colleague, Sarah, same age, same lifestyle, she has 2 kids, she had a stroke at work at her desk. Now, fortunately, she survived, but couldn't work for 8 months. And Emma watched her friend, her work colleague, struggle with recovery, caring for her children, her finances. She watched her really, really struggle. And I think the sad reality of it is we often think that these things won't happen to us until they do. So Emma came to me after a situation, then wanting to discuss these things, which you could argue sometimes is just a bit too late. So before we dive into the types of protection, I want to show you why this matters. And this is what I call the financial pyramid. As you can see at the bottom, the foundation is protection and insurance. And what we protect is what we earn, what we own, what we owe, and those you love. Now, throughout our journeys in life, we typically start with trying to save towards something. We save towards emergency pots, upcoming purchases, holidays, financial security. And as time goes on, we start thinking about more things. We maybe invest in property or buy our own home. We start thinking about later on in life about retirement, our children's future. We start paying into pensions or thinking more about our pensions. And then right at the top, towards the end of our financial journey, we might actually start thinking about retiring and retirement planning, inheritance tax, and leaving a legacy. But the core foundation of this is all about protection, because everything above that is completely vulnerable without it. So I want you to picture that, let's say you've got £30,000 and it's taking you 5 years to save, 10 years to save £30,000. Let's assume that tomorrow you just cannot work. All of a sudden you're diagnosed with cancer. Now your mortgage is £1,500 a month, bills, food, general living costs are £1,500. That's £3,000 a month. £30,000 is now gone within 10 months. Now, of course, this all comes down to your individual family and those dynamics. Maybe you're the breadwinner. Maybe your partner's the breadwinner. If it's you, I want you to think, well, if that happened to you, how does that affect your significant other, your family, your children? If it's your partner, how does that impact you and the whole family dynamics? Protection is really, really important to consider, and it's the real foundation of everything. So let's put this into perspective. Here are all the various types of insurance many of us have right now, probably without thinking twice about them. Sometimes we even forget we have them. We get breakdown cover for our car, so we're not stuck on the motorway. Pet insurance for the cat or dog, gadget cover, boiler cover, travel insurance. How often have you last minute forgot to get your travel insurance? I know I always do. Contents insurance for everything in your home, TVs, sofas, jewelry. We'll make sure that our contents are covered, but ironically, it's not often we think about protecting the income that buys those contents in the first place. We often protect items and things without hesitation, but don't protect the person who earns the money to pay for these things. If your boiler breaks, don't get me wrong, it's obviously inconvenient, certainly around this time, but it's replaceable. If you break, you're a lot harder to replace. So these insurances tend to be a small monthly payment for tangible things we can see and touch. They feel worth it because we might actually use them. But our own insurance, our own protection, that asks us to think about uncomfortable scenarios. It's easier to insure stuff than confront our own vulnerabilities. And the irony is, if something happens to you, all that other insurance becomes meaningless anyway, null and void. Your family won't care about the boiler cover if they can't pay for the mortgage. So let's shift our focus to what actually matters. When we think about protecting ourselves properly, it comes down to 3 interconnected areas: family, health, and income. They're all connected because you can't really separate them in real life. Family is the people who depend on you, health, your physical and mental well-being, and income is your ability to earn and provide. When your health fails, your income is at risk. When your income disappears, your family struggles. If something happens to you, your family's entire foundation can crumble, sadly, overnight. They're one interconnected reality. And that's exactly why we need various different types of protection that work alongside each other. So, family protection. I want you to ask yourself, if you weren't here tomorrow, what would happen to the people who depend on you financially? What happens to your mortgage or rent? Who's going to pay that? Who pays the bills? Where does that money come from? Can your family stay in their home? Can they maintain the same lifestyle? Or would they need to uproot everything? Well, if you have children, what about their future? What will happen to them? So let's take this example of James and Sarah. James, 39 years old, 50 grand's worth of income. Sarah, she works part-time. She mainly cares for children. Teaching assistant, £16,000 a year income. They have a mortgage, £300,000, 2 children under 10. No health issues or concerns. They take regular family holidays. Now, one day, out of the blue, Sarah gets a call. James, while playing with his son, has a brain aneurysm. And sadly, before the ambulance arrives, he dies. Now, instantly, his household, or the household income, drops from £66,000 a year to just 16. Monthly income that was comfortable, 4.5 grand, goes down to 1,250. But the monthly bills don't stop. The monthly bills of £4,000 are still there. And Sarah, overnight, now really struggles in being able to afford all the bills. Now, you might think, well, sell the house. But can you imagine, in a time like this, you've just lost your partner, you've got 2 kids to look after, your household income has dropped significantly. It's not something you can just click a finger and sell overnight. So Sarah, with the small savings that she had, used that to try and to pay for the bills. But after 4 months, her savings are done. There's no protection outside, and therefore she had to sell the family home. And doing so, that meant that she had to move far from family, far from her safe circle. The kids uprooted, moved schools, different areas, everything uprooted. So coming back to that won't happen to me, it can, it could, and unfortunately it happens to a lot of people. I want to talk about an actual, a real personal story to me, which happened to a very close friend of mine last year. Jane was out shopping with her 2 kids and her sister. They're heading back, they get to the house. Jane uses her key to open the door. Well, she rings the doorbell, there's no answer. So she gets her keys, opens the door and finds John face down in the hallway. Now, as you can imagine, she's got her 2 kids with her. It's chaos. The sister's on the phone to the ambulance. Jane's trying to find out what's happened to her husband. The kids are obviously crying. Now, turns out that John had a heart attack and he died. This happened to a real close friend of mine. So I was very much directly involved with the whole situation. And I want you to imagine that Jane, she didn't work. She looked after the kids. She had no income. She had no savings. Now imagine if John had no form of family protection in place. A freak incident that completely destroys the family in seconds. Now John, he did have death in service through work, but it was only a small amount of money. So it wouldn't have actually covered the whole mortgage or even provided for Jane. So fortunately, a long time ago, I set up a form of family protection, life insurance, that meant that if anything happened to John, the mortgage is completely cleared and Jane has a separate pot that she can use to draw income from. So she hasn't got to worry about paying for the mortgage. She hasn't got to worry about paying for all the bills, or being forced to work imminently, again, with 2 children that she has to look after. At the end of the day, was Jane thinking about her life insurance when she saw her husband laying in the hallway? No. But that financial protection there in place, that has saved the whole household and the family dynamic. So we spoke about family protection in the sense of a lump sum that's paid, but you can actually have monthly ongoing support. Family income benefit, which is a type of life insurance, that pays out a regular income, which could be monthly or annually, for the remainder of the policy term. It's regular monthly installments as opposed to a single lump sum. The policy term is set with like a specific need. So sometimes it's to pay for a mortgage, it's to provide for children until they're adults, or to support a spouse until retirement. It can be a level amount, it can stay the same, let's say £1,000 a month, or it can be on a decreasing basis where it starts at a certain figure and then it decreases over time. Some people may do that to cover, let's say, a mortgage, for argument's sake. So the second part of that Venn diagram that we looked at earlier is income protection. And I want you to ask yourself the same question as before. Instead of you no longer being around, what would happen if your income completely stopped? Well, it's the same questions that we have to answer. How is your mortgage or rent being paid? Who is going to pay that? Who pays the bills? Where does that money come from? What if you couldn't ever return to work? What if something so serious happened that you were just unable to work from that point onwards? Can you or your family maintain their lifestyle, or do they have to completely uproot everything? And again, what about your children? There are various different types of income protection policy. I think the main thing you need to be mindful of is what we call a deferred period. So a deferred period is the point at which you call up the policy provider to make a claim and the point in which they pay out. So a typical deferred period is normally around the 4-week mark. And that's to make sure that you're not trying to claim for your little things like your colds or your coughs or man flu for the men out there, ladies. I know how tragic that can be for you. Man flu is obviously quite tragic for us men. But it's to make sure that you're not covering things like that. It's making sure that if you're claiming this 4-week deferred period where clearly you're still out of work and you still can't earn an income. So depending on the policy, the claim could pay out for 1 year, 2 years, 5 years. Sometimes it's throughout the duration of your working age. So I've pulled some stats from a well-known provider around income protection. So the top left-hand side, you can see the average claim payment period. So for someone that's taken out a 1-year type policy, the average claim was 5 months, 2-year, 8 months, and full term, which is until the end of that policy, the average claim period is 2 years and 10 months. Interestingly, the split between male and female, males is a lot higher, and the average age of an income protection claimant is just 39 years of age. Now, what might surprise you here on the left-hand side, this isn't just for this particular provider, this is very much common across all providers. Musculoskeletal, nearly 60% of claims is for skeletal, that's a difficult word to say. So that includes things like arthritis, gout, tendonitis, sciatica, fibromyalgia, osteoporosis, things like that. So you can clearly see it's a huge chunk compared to the rest of the other claims. So moving on to critical illness. So we were talking earlier about the family health and income. This is critical illness, which, going back to the diagram, we can technically split into two, right? We've got critical illness and what we call private medical, which some of you may get through work. So if you think back to James, he suffered a brain aneurysm. Unfortunately, he died, but let's assume that he survived. Now, a critical illness policy would pay out a tax-free lump sum. Now, you can do whatever you decide with that tax-free lump sum. Some people may try and clear debts. Some people don't want to go back to work or can't go back to work, so they treat that lump sum as a type of income. Some people might, I don't know, clear a mortgage. I've had a situation where, because of the type of claim, someone had to build a lift within their house, so they used that money to do that. So critical illness, again, I've gone back to the same provider and looked at their claims report that they file every year. And we always call it the big three: cancer, heart attack, and stroke. Now, nearly 2/3 of the claims are because of cancer. And shockingly, the average age of a claimant is 51 years old. Heart attack, just 54, and stroke, 51. It's a real scary thought. And like I say, this isn't to actually, worry you or scare you, but this stuff happens around us all the time. You may know someone that this has happened to. It could be a close friend, family member. Unfortunately, this stuff happens all around us. Now, if we actually drill down into the cancer claims, the biggest there being breast cancer at 31.9%. And again, shockingly, the average age of a claimant is just 50 years old. All of these are very, very young. Again, it happens to us. It happens to everyone around us. For this particular provider, females are actually the highest split of claimants, and the oldest was 75 years old, and the youngest was just 23 years of age. But I want to point out there's a reason for that. This particular provider offers children's critical illness cover. It's a type of policy that you can add on top of yours that covers children up until 23 years old. So anyone under 23 years for this particular provider has their own claimant's record. And it's scary to read it. This is children's critical illness cover. The amount of paid out claims just last year was 1.1 million. 35% of those under age 23 claimed because of cancer and 12% because of death of a child. Again, it's horrendous to think about, that this stuff is happening all around us. It's something that we really need to protect. So I mentioned earlier on about the various types of health. So we've discussed critical illness, which pays out a tax-free lump sum. Alternatively, you could have private medical cover. As mentioned earlier, some of you may get this through work, some may not. Over 2 in 5 who are using or considering using private healthcare services are doing so because NHS waiting times are too long, with a third also citing the quality of care and difficulty assessing appointments. So 44% of these people decided that they wanted private medical care because they felt the NHS waiting times are too long. I think it's fair to say that the NHS is struggling. It's no secret that more and more people use the NHS each year, yet it has been underfunded for quite some time now. Private medical insurance is designed to cover short-term curable conditions. So this typically includes things like diagnostic tests and scans, MRI, CT, ultrasounds, specialist consultations, surgeries and procedures, inpatient and outpatient type cover. So PMI is designed to work alongside the NHS, not as a complete replacement. So if we think back to our previous slides, cancer was one of the biggest claims for critical illness policy. So this means PMI would cover diagnostics tests, chemotherapy, radiotherapy, surgery, or active treatment alongside that care. So you have the two options there. Now you can mix and match, as I mentioned earlier, that all these are kind of interconnected. So some people have family protection, they'll have critical illness protection, and they'll have income protection. Everyone's circumstances are completely different. We really need to try and link it with if you get any type of cover through work, but sometimes that's just not enough. It might not. I think it was the earlier situation where he had a policy through work, but it didn't cover the entire mortgage. So we need to factor in things like that. And we mentioned earlier as well about business protection at the beginning of this webinar, that maybe for some of you this is important, maybe for most it isn't. But the same types of protection are available. Family protection, what we class as life insurance, is taken out by the business and paid for by the business. Income protection, again, same story, taken out by the business and paid for by the business. Now, critical illness cover, we call it key person for business protection. It's designed to protect the business if a key person dies or becomes critically ill. And something which we call shareholder protection is designed to provide financial security for a business and its owners when a key shareholder dies. I don't want to dig too deep into this because it really does relate to individual circumstances, as that will determine whether this is suitable or not for your specific situation. We've got to be a bit careful around what you can claim as business expenses and what you can't. So certainly business protection is something that you should speak to an advisor about and get good, clear guidance on. So finally, I want to stress the following. Protection isn't something that you can mess around with. Let's be honest. You've got to be careful with the type of protection that you're taking out. Unfortunately, I've dealt with a lot of people that I've taken on in clients in the past that have a type of protection and they took it out because it's cheap, right? Now, cheap, unfortunately, isn't cheerful in the insurance world. There could be many a situation, and I've dealt with many a situation, where there are certain exclusions or certain terms that aren't covered. So I think when it comes to securing or taking out types of protection, it is important to get advice. Or if you try and do it yourself, you really got to work out exactly what terms are covered. Sometimes if you've got certain medical history, they will have exclusions in play. So for example, if you've had someone that's got a family history of cancer, it's potentially a potential that if you were to claim, they won't pay out if it's cancer related. Now, of course, again, each provider is completely different. But what's important is, without really thinking about straight away, well, do I need life insurance? Do I need to protect or do I need income protection? What matters to you first? What actually keeps you awake at night? Who depends on you? What would happen if your income stopped tomorrow? What financial obligations would continue if you were no longer around or couldn't work? Those answers tell us what protection you need. The insurance label comes second. So that's me. I'm Darren Ford. As I mentioned, I am the fun one at parties. I talk about this stuff all day, every day with clients and potential clients. So if you wanted to get in touch, by all means, my details are there, email and phone number. If you're an Instagram person, you can add me on Instagram. I post stuff as regularly as I can. But I think, again, it's important to stress that with protection, it's not something that you want to cut corners on. The worst thing, and unfortunately I've seen it when I've taken on certain clients, they could have been paying for a certain type of policy for 15, 20 years. And then when I dig deep into the type of cover, it didn't actually cover them for what they thought they had cover for, or there's certain exclusions in place. So you've got to be really careful. If you're doing it yourself, just make sure that you're really digging in deep to all the policy terms and the paperwork. If you decide to reach out to an advisor, again, I'm more than happy to help. Yeah, feel free to reach out to email or phone number. So hopefully that was all really helpful, and I'll pass back to Ivy.
Thank you, Darren. As usual, a really insightful session. We have had some questions, but I'm just going to put the invite out there again because we've got some time for any questions that anyone's got. If you pop them into the chat or the Q&A function of the webinar, we'll go through as many as we can. But I've gathered a few, and I think I might start with this one just because it relates to the slides. So we had a question around, were the costs in the previous slides per claim or total payout for the type of claims?
Was it, say that again, sorry, was it the cost
were the costs
the claim
in the previous slides per claim or the total payout for the type of claim? So where you had like count, okay, total, perfect.
Yes, yeah, I think one of them was like £1 million. No one's having a payout of £1 million for that specific policy. It's the total per average or per claim, yeah, per average claimant.
Got it. Thank you. Thanks, Darren. So I've got a few more questions. Just bear with me. I'm trying to organise them so that they are in an order and I can keep track of which ones we've answered and which ones we are yet to answer. So one of the questions we had was around kind of a lot of insurance policies having loads of small print. And I know you just touched on this, to allow the insurance company to refuse payouts in as many cases as possible. For life and income protection insurance specifically, is there any information around percentage of claims that get rejected, meaning, you know, circumstances where people have paid in for years or even decades and then potentially been left with nothing when, you know, unfortunate situations do strike?
At the end of the day, these providers, they do want to pay out, believe it or not. It's not their job to sit there and try and exclude people, but they have to be realistic at the end of the day that some people, unfortunately, do not declare all the relevant information when it comes to insurance. So for life insurance, it is pretty straightforward. It's the most straightforward of them all. If you've died, they pay out. Now, when it comes to income protection or critical illness insurance, there is going to be various types of small print. They do need to dig in deep around your medical history, your family's medical history. So I had a situation yesterday where her family have, well, 3 or 4 members of her family have had cancer. So during the application, they needed to have screening for that particular, my client, that particular person, to make sure that there was nothing untoward going on. So in terms of small, you've got to just make sure that you declare everything, right? You have to be open and honest. You can't think, oh, well, yeah, maybe that happened 5 years ago, but it doesn't matter. You write down absolutely everything so they're completely aware of your circumstances. And then it's highly unlikely, providing you've been completely honest, that they wouldn't pay out.
Great. Thank you, Darren. So I think the sort of rule of thumb there is more disclosure, the better.
Disclose everything.
Okay.
You've got to make sure, because there'd be nothing worse than paying a premium for 15, 20 years, and that your most vulnerable moment, when you need that policy the most, they do not pay out. And when they dig in deeper, it's because of maybe a type of family history or a type of condition you had that maybe you felt wasn't important, but makes all the difference to them.
Right. And would you say then that actually it's probably one of those things that, you know, I guess because circumstances change over time and we might have a policy for a really long time, is it worthwhile kind of reviewing that policy and sort of updating anything in our circumstances that has changed to make sure that we are continuously sort of disclosing any changes?
Yeah, so in terms of disclosing new changes, the brilliant thing about protection providers is that at the point you take out the policy, that's all the information in the past is what matters. So if you've had various things happen from the point you took out that policy moving forward, that's excluded. You weren't to know that was going to happen. You don't have to disclose that stuff as time goes on, because they've underwritten the policy based on your medical history or family history at the point you took the policy.
Okay.
So yes, you've just got to make sure that you disclose everything.
Fabulous, thank you. So we've had a question around sort of family history and who that family is. So is it parents, grandparents, aunts, uncles? Is there a definition of kind of family history, who to include?
Yes, so typically the most common question that providers will ask is its immediate family. So mum, dad, sister, brother, typically. And they want to know about family history for when they are age 65 or under. Okay. That's typically the most common questions they'll ask. So if you've had a family member that's had a type of heart attack, cancer, stroke, and they were 67, typically, not all providers, but typically they would ignore that. Whereas if that happened when they were 50, 60, then that's something that we would typically have to declare on an application. And again, because what they're trying to make sure that these things aren't hereditary, right? So, for example, the client that I had yesterday, she's got real strong family history of cancer. She hadn't had any checks herself. Mm-hmm. So the provider wanted to have a screening, wanted to make sure that there's definitely nothing underlying there that she needs to be concerned about, or the provider need to be concerned about.
And is it typical to have a screening, or is that something that comes up dependent on the provider and dependent on the policy and kind of the risk of the individual?
Yeah, so typically with age, depending on your background medical history, they may ask for a screening. Again, if it's something that they think is hereditary, then they may ask for certain screenings, or for example, there's tests around smoking. So if you say on the application that you used to smoke, but you stopped over a year ago, they may send out a test for you to do to prove that, essentially. There's various little small tests that they can do. Again, it does depend. If you've got a real clean record, it's unlikely that they would request any evidence or need any type of screening. But the more family history, or the more history you've got personally that you declare, is potential that, yeah, they need to know or dig in a little bit deeper.
Okay, thank you. So we've had some questions around kind of specifically, you know, someone who's perhaps 59 and about to take on a mortgage, could they expect to potentially pay higher premiums for mortgage protection because of their age that they're taking out that mortgage?
Yeah, so the younger you are, the cheaper it will be, right? The older you are, from the eyes of obviously the insurance provider, unfortunately, you are more risk to them. So if you're 20, you've got no family medical history, you're a clean slate, then yes, premiums would be really, really low. If you're 60 and you're trying to take out an equivalent amount of cover, it would be more expensive. The chances are that they're more likely to pay out in your situation than not.
Got you. So just kind of on that topic, just I guess a commonly asked question, but one that's not been asked specifically on this webinar. What are common mistakes that people make when choosing protection insurance, and what things could we share from a sort of a tips perspective with our attendees today of things to consider when choosing or looking to choose protection insurance?
Yes. So, yeah, a big one, because when I'm dealing with certain clients, if they've got existing protection in place, that's something I always review. I want to make sure that they know what they're paying for, or if we need to update their protection with, new policies. So, income protection to start. You can't just go selecting however much income you want. Okay, an income protection provider will typically cover 60, sometimes at a push 70% of your gross income. Okay, so a lot of the situation I've had, maybe income protection is one of those policies that we do review more regularly than maybe say a life insurance, because if your income is fluctuating, if you, for example, had a higher paying job and you had income protection, and then in 10 years time you went to a job that paid a smaller sum, but you still were trying to protect your income based on your old salary, they won't pay out. Okay, because you could be trying to claim £5,000 a month when actually your net income is £1,300 a month. So income protection, you can update yearly, every couple of years, depending on if you change job. Again, you don't want to be paying the premiums to pay out £5,000 when you're only going to get 1,200 or 1,300. So that's income protection. And the deferred period on income protection is important as well. Some people are completely unaware around the deferred period. I mentioned in the slides that the typical one is 4 weeks. But don't forget, a lot of people, and this is where it's good to factor in your work-related benefits, a lot of people may have sick pay through work, which could cover them for 4 weeks. Those that may be in the NHS and things like that, public services, they could have 6 months of full pay and 6 months of half pay. So the deferred period we can change depending on when their work benefits end. So you can't have your own income protection policy that pays out 70% of your income while you've had your work benefits pay out, because you wouldn't go back to work. You've got 100% plus of your income. So the policy providers need to make sure that you are only covering 60 to 70% of your total income that you're receiving at that point. So that's income protection. Critical illness, again, it's going to depend on definitions, right? Some people say to me, oh, I want to keep this policy. It's 15 years old because it pays out for this specific critical illness. When actually, when we dig deeper, there's some nuances to that. Sometimes it doesn't actually cover that, or you get a lot of providers that may say, well, yes, we would pay out, but only, for example, cancer, only if it's stage 3 or stage 4. If you have basal cell carcinoma, like skin cancer, or a smaller, lower level grade of cancer, they may not cover you. So again, it's important. The policy definitions will state all this. All the critical illness policy providers will have a long old document that will say what they cover, how and when. Again, it's my job to go through all that and understand what people need cover for. But yeah, you know, protection is important. It's important to make sure you get it right. For me personally, when people come to me, I mean, there's various ways that I help clients. I don't charge in order to help people with protection. It's a completely free initial consultation, and it's free for me to set up protection policies. So I know that's been a concern in the past where people may have to pay to get these policies sorted. But for me personally, I don't charge.
Thank you, Darren. We've had quite a few questions. So these two are, I think I'm going to link these questions together. But there was one question around, are there specific details, clauses people should look for in their policies to ensure that they have the most comprehensive cover? And then there was a different question, but I feel that could be quite nicely linked, which is, because there are so many providers and products in the market, what are the top 3 criteria that people should be considering? So maybe not the specific type of insurance, but kind of the overall performance of the organization. And is there an independent sort of rating or monitoring to look out for when kind of looking at these products? Because it can be a bit overwhelming because there's so much choice out there.
There is, and I think that's why people like me exist, right? That's why there are many different advisors and brokers on the market that help with this type of stuff, because there is many different providers that offer different things. So first part of that question, it ultimately comes down to premiums, right? Not always, but the cheaper the premium, this does of course depend on age, but the cheaper the premium, typically the lesser the cover, right? So if you try and think of like travel insurance, for argument's sake, when you go and compare the market and you get the cheapest one, it could have 3 stars instead of 5, that de facto rating. Well, when you then dig deeper, it could be that it only covers £100 if your luggage went missing, or, you know, medical expenses only 1,000 instead of 10,000 or 1,000,000. But obviously, as you go down that list and pay a little bit more, those stars get a little bit longer, and you get 5-star de facto rating. It's exactly the same when it comes to insurance. So you can have providers, for example, Aviva. Aviva may have a critical illness policy that's almost standard. It could cover 20 conditions, but they'll have a critical illness plus, which could cover 40 conditions. Again, the premiums can be more expensive. The chance of you claiming on that policy, on the plus element of it, is higher than not. So you're paying for what you get. So that is something that you do need to be aware of. Again, you don't want to go cheap all the time. You do want to, you want to do your comparisons online, right? And that second part, sorry, I can't remember already.
So the second part was around, well, I think you've covered it. So there was the element around the criteria that people should look for and sort of independent ratings. So just for kind of my comprehension, would it be around kind of looking at those exclusions and those things that are included and excluded within those policies, and just taking a real fine tooth to some of those and looking at those excesses and working out actually which of the various policies, comparing them, is most suitable for the individual?
Exactly that. Sorry, exactly that. So don't get me wrong, it's difficult for you to be able to compare these types of providers, because they could provide a 60-page document around the types of critical illnesses they cover, And then, you know, a lot of time you've got to be a doctor to sit down with the other 60-page document from the other provider and one by one work out what does one cover and what doesn't.
Yeah.
People in my job and my industry, we have systems that help us with that. You know, I'm not a doctor. I get surprised when I see certain things come up with medical history. I've got no idea what it is, let alone say it. So we have certain types of systems that we can use to try and ascertain exactly what that is and maybe how one provider would pay out compared to another. Some providers will pay out 100% for specific conditions only. Other providers might say, actually, we have a list of what we call additional payouts, which is smaller types of payout. So instead of you having stage 4 cancer, if you have stage 2, they will pay out, but a smaller sum of the amount that you are paying for. So it really does. It always varies. I do think with critical illness cover, getting some form of advice would help massively. There's also a lot of policies that were taken out 10, 15 years ago that could have had a lot more definitions on them than today's. So if you think just because the policy is old that it's no good, not necessarily. I've had it a couple times where the list of conditions are far better on a really old policy than for the same provider today. So you don't want to just go cancelling stuff willy-nilly.
Understood. We've had a question around income protection cover and if that covers you if you get made redundant.
No. So I don't really think there's this type of policy really on the market anymore. If there is, it's maybe one or two. Unemployment cover or redundancy cover used to be a thing. It's renewed every year. I don't think many providers offer that type of cover anymore. Income protection is going to be solely that you're working and you're just unable to work because of sickness, illness, injury, not redundancy.
Okay, and the kind of follow-up question that we've had was around kind of whether the income protection would cover if there's a health element because the redundancy has caused like mental health issue, for example, and therefore preventing that person from being able to work going forward. So the redundancy has had a health impact, which has then had an impact to the person's income, so loss of income because they've not been able to return to work.
Yeah, that is definitely possible. Again, it does depend on providers. Like many things, providers will offer different types of cover. They're not going to pay out if you're just made redundant and you're trying to cover the gap of basically not being able to work. But if you suffered from something that led to your redundancy, or you've been made redundant and that has led to mental health, for argument's sake, that meant that you can't get a new job, that is something that some providers could look at.
Obviously, we're not able to provide specific advice and it will be very much dependent on the person's circumstances. So we are speaking in very, very general terms here. So this is an interesting question. So someone's asked, I've seen some policies ranging from £50 to £80 a month. Most would only pay out for 12 months consecutively maximum. If I could manage 1 year income loss through savings only, at what point is it worth it to consider protection insurance?
Okay, so obviously this individual's looked at income protection, I'm assuming, right? So there are providers that will pay out for a year, 2 years, 5 years, sometimes for a whole policy term. It could be 30 years, right? I think you need to, this is where individual advice comes in because it isn't throw a blanket over everyone. Everyone needs income protection, so just go out and get it. Okay. You need to really factor in your lifestyle and your situation, your individual circumstances. Yes, you could sit there and say, well, I've got 12 months worth of savings and that would cover me if I'm out of work. But that puts you in a very vulnerable position that you're now having to use your own savings to try and top up income. So let's say that you're only out of work for a couple of months. Okay, you could argue that, you know, your savings have covered that, you've still got a savings pot, fine. Obviously, we don't pick and choose when we're out of work or how or why. So if you're out of work for a full 12 months and you've used all your emergency pot and your backing savings, now you've got nothing. So you need to weigh up whether you could sleep at night, right? If that happened, and whether you've got other ways of being able to protect income. If you're working and you've got workplace sick pay that can cover you for 6 months of that, then maybe you have a type of policy which has a deferred period of 6 months onwards. So then you're never using savings, but it's a cheaper type of policy because the deferred period is longer. They're not going to pay out until a much longer time frame in the future.
Sure. Understood. We've had a question around if there's any limitations to nationality. So if someone's a UK resident but not a UK citizen, can they still purchase insurance?
Oh yeah, that's not an issue. The only time that it potentially becomes an issue is, let's say, I mean, it just has to be declared. Let's say you live for 5 months in the UK and you travel back to see family for a month, a year, in wherever. You've just got to be conscious that you declare that's what you're doing, because touch wood, if anything happened while you're out there and they were unaware that you traveled out there, that would cause a concern. We also need to be wary of where you're traveling to. Okay. I had a situation a few months ago where this individual's family lived in Iraq. Now, obviously, with everything that's going on out there, unless we went to a real specialist provider, your typical providers would not risk insuring this individual, because the time that she was out there, it could result in, obviously, there's more risk of her being able to claim. So we've got to be really careful of that. Different providers will allow different countries or be less concerned, more concerned. It always varies.
So you've sort of answered a question that was linked to this one, which was around if you work overseas for a period of time, for example, so you've had a change in circumstances and location after you've taken out a policy, would you need to notify the provider? I think the answer is yes. Yeah. Based on what you've just said. And we've had another question around the mortgage protection examples. So the examples that we used in the slide deck were around couples where one person in the couple would be the beneficiary in case of death of the other. But can a beneficiary of protection insurance be someone other than the spouse or partner? So for example, a child or a non-resident family member, so perhaps a family member that lives abroad.
Absolutely. It's your protection policy. You can decide who the beneficiary is. Okay. With life insurance, we do have to be a bit careful. If it's a joint policy, then automatically, if one person were to claim, it would go to the surviving partner or spouse. Okay. If they are not married, we've got to be really careful here around how much the life insurance covers you for. Because if one individual were to die and they're not married, the lump sum that they could receive could form part of their estate for inheritance tax purposes. Yeah. So if they just fall under the inheritance tax threshold, that the life insurance gets added on top and takes them over it, 40% of that policy could disappear to inheritance. So there's ways around that. We write policies into trust on behalf of the beneficiaries, so it completely avoids the person's estate. That is really important when it comes to life insurance policies. But yeah, again, each individual circumstance is different. The beneficiary could be whoever you want it to be at the end of the day. If it's for someone under 18, again, we've got to be careful. It would have to be written into what we call a minor's trust, because anyone under 18 typically isn't allowed to just receive a big lump sum from life insurance. So it'd be kept within a trust until they turn 18, or you could do a different type of trust, which they won't receive until they're 21. Or however old.
Got you. So I guess the thing to also bear in mind is kind of estate planning and kind of that aspect alongside some of these types of insurance, and thinking of change of circumstances and life events. So for example, if there's a relationship breakdown, just being mindful that you may wish to update your beneficiary as well, potentially. So yes, I think we've got a couple of minutes left. left. So I'm going to see if we've got one last question that we can get to that we've not covered.
Just going back on that point that you mentioned, Ivy. So if you've got a joint policy and you have separated, a lot of policy providers do add what we call a separation benefit, where technically you can split the policy straight down the middle, and therefore you both continue with your own cover. So that is something that is kind of pre-written into some of these policies. But quite rightly, if you've been in a relationship that's broken down, then yes, reviewing your insurances, especially life insurance, you want to make sure that your beneficiaries are as you want them to be. That if it's been planned to go into trust, it's not now going to that individual. Your will, for argument's sake, if you had an old will, you want to make sure you update that with new beneficiaries or new information. There's always a lot at play here. I think that's why advice is important in this sort of area. You don't want to get it wrong.
And also your pensions beneficiaries as well is probably worthwhile
100%.
reviewing, which is one of the things that I know it's a callback to our previous webinar, but yeah. So I think just one last question. There was a question around, so this is around the sort of, having access to family members' medical history. So when you're applying for insurance, if you don't have access to immediate family members' medical history for a variety of different reasons, is that an issue that could prevent a claim, or is that something that insurers are actually quite well versed in dealing with?
Okay, so I'm not sure if they mean that if they're trying to get on insurance on behalf of a family member,
for themselves,
but they don't know their family medical history, right? So yeah, the first port of call is you want to try it and find out, right? And I appreciate that not everyone can find out that information for various reasons. When you do insurance applications, a lot of the time for family medical history, there is an option to essentially say, I don't know. That would then mean that it's pre-written into their underwriting process. So they need to assess that there could be some underlying family history that you don't know about. So the premiums would reflect that risk, essentially.
Got you. Thank you, Darren. And thank you for everyone's thoughtful questions and participation on this webinar. We do hope that you felt it was an hour well spent of your day. But just before we conclude, I know that my colleague Jake has been putting the polls in and the feedback. So if you could submit feedback, because it is really important to us, and any additional comments, suggestions that you might have that we can bring forward into these webinars is greatly appreciated. We will be circulating as soon as we can the programme for 2026, so do keep an eye out, and as soon as the recording of this session is ready, we will circulate that as well, so please do request the recording if you are interested. Thank you, Darren. Thank you everyone for joining us today, and I do hope that you all have an excellent afternoon and a great rest of your week. And if you have been impacted by any of the scenarios and circumstances and want to talk to one of our counsellors, do phone through to our EAP. Thank you everyone. Take care and goodbye.